Imagine reporting a $12.4 billion financial loss in a single quarter.
Right, which is just a staggering number.
Yeah, and then Wall Street responds by giving your stock this massive buy rating. Yeah. Or, imagine firing 14% of your staff, not because you're running out of capital, but just because an AI agent can do their jobs faster.
It's wild. Today, that traditional corporate blueprint we all know isn't just changing, it's actively bursting into flames.
It really is. Hello, everyone, and welcome back to NovaStream. If you are just joining us, a quick reminder that this channel streams 24/7.
We never sleep.
We really don't. We've got the live crypto markets running right now, those dynamic sparkline charts for Bitcoin, Ethereum, all your major altcoins. We're tracking the global financial indices, S&P 500, NASDAQ Q, Forex pairs, and of course we have that auto-curated breaking news feed scrolling at the bottom of your screen.
Always keeping you updated.
But right now, you and I are going to step into our study room, so to speak. We're stepping away from just the raw data for our highlight of the day.
Yeah, taking a breath to really look at things.
Right. This is our curated exploration of the most crucial headlines crossing the wires today, May 6, 2026. Our mission here is to help you cut through the absolute noise of the financial and tech worlds.
Because there is so much noise out there right now.
Oh, an unbelievable amount. We want to show you the mechanisms underneath it all. And the overarching theme today is, well, it's the sheer scale of the pivots companies are making.
Yeah, we're seeing artificial intelligence transition from just, a product that companies sell into this force that is violently reshaping their internal operations.
Like tearing them down to the studs. Plus, we're seeing billion-dollar tech hardware making these historic comebacks and some truly wild paradoxical market reactions to earnings reports.
It's a busy day. Where should we start?
Let's start with that internal AI reshaping because it is no longer theoretical. AI is not just a chatbot answering customer service emails anymore.
No, it's tearing down the traditional organizational chart.
Look at Coinbase.
Yeah.
They just announced they are laying off 14% of their workforce. That's roughly 700 employees.
Which is a massive cut.
Huge. And it carries a cost of between $50 million and $60 million just in severance and associated charges. CEO Brian Armstrong is pivoting the company to what he calls AI-native pods.
AI-native pods, that sounds very sci-fi.
Right. The goal is to utilize AI to allow one-person teams to act as engineers, designers, and product managers all at the exact same time.
Wow. All three roles.
Yeah. They're claiming engineers can now use AI to complete tasks in days that, used to take weeks. It allows them to slash management down to a maximum of 5 levels below the C-suite.
I mean, this is a drastic flattening of the corporate hierarchy. Coinbase is basically betting that AI can act as a universal translation layer.
What do you mean by translation layer?
Well, historically, the reason you needed an engineer, a designer, and a product manager on a single team is because those are 3 very different cognitive languages, right?
Oh, sure. Writing code is totally different from drawing a UI.
Yeah, exactly. The mindset for coding is different from designing a user interface, which is different from, managing a product timeline and keeping everyone on track.
Okay, let's unpack this, because I have to push back a little on the reality of that strategy.
Go for it.
Is a one-person team utilizing AI actually scalable for a massive, globally regulated crypto exchange?
It's a fair question.
Right. Asking one human being to hold the entire vision of a product feature, write the code, and design the wireframes, even if an AI agent is assisting, that just sounds like a recipe for extreme employee burnout.
Oh, the pressure would be intense.
It feels like they're disguising an intense pressure cooker as technological innovation.
It is a high wire act, absolutely. And the human toll is definitely the unspoken variable here. I mean, if the AI hallucinates a line of code or the integration fails,
that one person is on the hook.
Yeah, that single person carries the entire weight of the failure. There's no one to pass the blame to. But Coinbase's core assumption is that AI reduces the friction of context switching.
Explain that a bit more.
So you don't have to wait 3 days for the design department to send back a button layout. You just ask the AI to generate it based on your code, you edit the output, and you deploy.
Ah, I see.
You transition from being a primary creator to being essentially an editor of AI output.
So the human becomes the bottleneck reviewer rather than the actual builder.
Yeah, that's a good way to put it.
But for those AI agents to even function, they need a physical home. Which brings us to the exact opposite corporate strategy happening simultaneously today.
Right, the hardware side.
Yeah. While Coinbase is using AI to aggressively shrink its footprint, Iron, which used to be known as Iris Energy, is spending massive amounts of capital to build out the physical world those AI agents require.
Ayer is a perfect example of this massive hardware pivot. They just announced a definitive $625 million all-stock acquisition of a company called Mirantis.
Mirantis. Now, they are a cloud infrastructure and Kubernetes specialist, right?
Yes, Iron is actively pivoting away from being a pure Bitcoin miner, which is what, the market previously knew them for.
Yeah, they were always just a crypto play.
Not anymore. They are attempting to become a full-stack AI infrastructure provider.
And the market is rewarding them handsomely for it. I mean, iron in stock is up 31% so far in 2026.
It's a huge rally.
It is. This is bolstered by that Mirantis news and the recent energization of their massive 1.4 gigawatt Sweetwater 1 data center in Texas. But why Mirantis? Providing AI infrastructure feels like it should just be about buying thousands of NVIDIA GPUs and, plugging them into a Texas power grid.
You'd think so, right? Just plug it in and turn it on.
Yeah. Why spend over $500 million on a software company?
What's fascinating here is the difference between having raw computing power and actually making it usable for an enterprise client.
Okay.
That is where Mirantis, and specifically their K-Treat platform, comes in. You mentioned Kubernetes earlier.
Right.
Think of a massive data center as a giant, chaotic shipping yard filled with thousands of containers.
Okay, I'm picturing it.
Kubernetes is the master logistics coordinator. It dictates where every single computational workload should go. It ensures no server is overwhelmed and no server just sits idle.
So Iron has the physical shipping yard, the data center, but they needed to buy the logistics coordinator to manage all the traffic.
Yeah, precisely. In the industry, they call this day two operations.
Day two. What's day one?
Day one is just getting the physical hardware online, turning the lights on. Day two is the ongoing, grueling reality of enterprise software.
Ah, the maintenance.
Right. The continuous monitoring, the security patching, the really complex workload scheduling across bare metal and virtual machines.
And Mirantis already has a foothold there.
They do. They bring 1,500 existing enterprise customers and that critical operational visibility, which, by the way, is validated by NVIDIA. Iron recognized that raw GPU muscle is essentially useless without a highly sophisticated software brain to direct it.
So we have Coinbase shrinking its physical workforce using AI software, while Iron is expanding its physical infrastructure to support that very software.
It's two sides of the same coin.
It really is. And it brings us to a massive divergence we are tracking on the global financial indices today. The market is currently wrestling with a wild paradox regarding how it values tangible hardware versus software platforms.
Yeah, the contrast is stark. Let's look at Intel.
Oh man, Intel's stock has exploded, up 175% year-to-date. Its market cap is now roughly $544 billion.
Which is just astronomical growth for a legacy company.
It is. Just to put that into perspective for you, this incredible surge means Intel has surpassed Oracle, they've surpassed Johnson & Johnson, moving into the top 20 largest U.S. companies.
Wow.
They are nearing their absolute peak dot-com bubble valuation from August of 2000.
A literal quarter-century comeback. And it's really driven by two things. First, a massive Q1 earnings beat of $13.58 billion in revenue.
Huge beat.
Yeah. And second, this intense enthusiasm over rumors of an Apple partnership utilizing Intel's 18A advanced node technology.
Okay, explain that 18A node for us, because that sounds highly technical, but it's clearly driving hundreds of billions in market cap.
Yeah, it's the magic word right now. The A stands for angstrom, which is a unit of measurement even smaller than a nanometer.
Smaller than a nanometer.
We are talking about shrinking the transistors on a microchip down to an almost atomic level. And when you make transistors that small, the electrons have less distance to travel.
Which means it's faster.
Much faster. And it consumes far less power. Intel's 18A process is basically their attempt to reclaim the manufacturing crown from overseas foundries.
So if Apple is truly looking to manufacture state-of-the-art chips for their devices on U.S. soil.
Right. Intel's 18A is the physical foundry they would absolutely need.
So the market is throwing billions at Intel for the physical capacity to build these microscopic components. But then, in a jarring contrast, we look at a pure software play, like Palantir Technologies.
Oh, the Palantir earnings reaction was brutal.
It was. They reported their Q1 earnings, and by all traditional metrics, it was home run. They posted record results. Revenue was up 85% year over year to $1.63 billion, beating estimates.
Yeah, they crushed it. They even raised their full-year guidance to over 70% growth. And what happens? The stock falls 5 to 7%.
The reaction was incredibly punitive. Wall Street analysts have Four specific quibbles with Palantir right now.
Break those down for us.
First, they argue the stock is simply priced for perfection. It's currently trading at roughly 56 times estimated 2027 free cash flow.
Which is very expensive.
Very. Second, CEO Alex Karp touted having only 70 salespeople. And analysts believe that is a massive vulnerability when you're trying to capture sprawling enterprise demand.
Interesting. What's the third?
Third is their international commercial business.
Yep.
It grew at 26%, which honestly pales in comparison to their U.S. commercial business, which grew at 133%.
Here's where it gets really interesting, though. Because the fourth quibble is the threat of what analysts are calling AI slop from competitors like OpenAI.
Yes, AI slop.
They fear these cheaper generative wrappers will eat into Palantir's market share. But is that a genuine technological threat? I mean, Palantir's bespoke ontology platform is like a custom-tailored suit. Right, it's built specifically for you.
Exactly. It takes time, it's expensive, but it fits your specific enterprise data architecture perfectly. Wall Street seems terrified that enterprise customers will just settle for off-the-rack AI slop because it's cheap and immediate, even if it seems rip occasionally.
Yeah.
Is that fear justified, or is it just an excuse to sell an overvalued stock?
If we connect this to the bigger picture, you really have to look at the psychology of the S&P 500 right now.
Okay, what is the market thinking?
The market views hardware and manufacturing as the absolute foundational bottleneck of the artificial intelligence boom. Intel's silicon foundries are scarce. It takes billions of dollars and years to build them. Therefore, Intel is rewarded.
Scarcity creates value.
Yeah. Software, however, is increasingly viewed as abundant, and abundance creates vulnerability.
Because anyone can spin up a cloud server and build a cheap AI wrapper.
Spot on. When a stock like Palantir is priced at 56 times future cash flow, there is zero room for a narrative shift. AI software valuations demand flawless execution.
So any crack in the armor.
Down goes the stock. When analysts see 26% international growth instead of 100%, or they worry about cheaper off-the-rack AI tools undercutting Palantir's expensive custom suits, they hit the sell button. Intel had a much lower bar to clear because they're a turnaround story in a sector the market is currently starving for.
So basically, Wall Street punishes the straight-A student for getting an A- and crowns the former class president for finally showing up to class.
That is a very accurate summary, yeah.
But if we move over to some other corporate strategies today, we are seeing companies entirely ignoring Wall Street's short-term logic.
Completely ignoring it.
They are powering through jaw-dropping financial losses to chase a long-term vision. Let's talk about Ford Motor.
Oh, Ford.
Ford has written off a staggering $20 billion in electric vehicle investments.
$20 billion.
$20 billion of capital destruction. Yet they're reporting today that they are forging ahead with a $30,000 affordable electric pickup truck slated for next year.
Legacy automakers like Ford are in an incredibly difficult structural position. They essentially have to run two massive capital-intensive businesses in parallel.
Explain that.
Well, they have to keep building the internal combustion engine vehicles, which act as their cash cows, but simultaneously they're funding what amounts to a massive internal startup to build EVs.
And startups lose money.
Exactly.
Yeah.
They are retooling century-old assembly lines, they're securing new battery supply chains, and pouring billions into research and development.
And they're taking those hits now to cross the chasm. That $30,000 pickup truck is the holy grail. It isn't aimed at the luxury early adopter. It's aimed at the mass market fleet buyer.
Yes.
They're betting that if they weather the $20 billion hit today, they secure their survival a decade from now.
It's an existential transition. But if we want to examine extreme capital destruction and corporate survival tactics, the situation with strategy is unprecedented.
Oh, definitely. For those following the crypto pairs on NovaStream, you know this company formally as MicroStrategy. Operating under the new name Strategy, their stock has plummeted 50% over the last year.
A massive haircut.
Massive. And this correlates with Bitcoin, which crashed 27% in the last 6 months to hover around $77,474 today. Because of that crash, Strategy just posted a $12.44 billion net loss in Q1 of 2026.
$12.4 billion in the red for a single quarter.
Unbelievable. Yet 12 out of 15 Wall Street analysts rate the stock a buy. They project a 118% upside with a target of $372.50, while it trades around $171 today.
It seems completely contradictory.
How does that even work?
To understand this paradox, we have to look at the mechanics of GAAP accounting rule ASU 2023-08.
Okay, lay it on us.
This is a relatively new rule that requires companies to report digital assets at fair market value.
So, to put it simply, if I buy a house for $300,000 and Zillow says the value just dropped to $250,000, this accounting rule forces me to declare a $50,000 bankruptcy-level loss on my quarterly income statement today, even though I haven't sold the house and my actual bank account hasn't lost a single penny.
That is the perfect analogy.
Okay.
The $12.44 billion loss Strategy reported is a paper loss. It is unrealized. Wall Street analysts look past that fair value accounting hit.
What are they looking at instead?
What the analysts are heavily focused on is a metric unique to this company, Bitcoin per share. Strategy holds over 762,000 Bitcoin right now, with a stated goal of reaching 1 million by the end of 2026.
Right.
As long as the amount of underlying Bitcoin backing each share of the stock is growing, analysts maintain their bullish thesis.
So what does this all mean for the listener tracking this? Because to fund those purchases, Strategy is heavily diluting their own shares. They raised over $25.3 billion in 2025 alone by issuing more stock just to buy more crypto.
Which is a huge gamble.
It feels like a dangerous game of chicken. And furthermore, there's a massive rumor crossing the breaking news feed right now. Despite former CEO Michael Saylor's famous echoing mantra to never sell, reports are suggesting Strategy is now actively considering selling some of their Bitcoin to cover operational losses.
Now, this raises an important question about their core identity.
Does it break the spell?
It might. The persistent share dilution is the actual mechanical risk you should be monitoring. If the rate at which they issue new shares outpaces the price appreciation of Bitcoin, the individual shareholder loses value.
Right.
And regarding the rumors of selling, if they capitulate and sell their holdings to cover debt obligations, it shatters the primary investment thesis.
Because they're supposed to be a vault.
Yeah. The market currently grants them a premium valuation because they are viewed as an impenetrable Bitcoin vault. If they begin selling, they transition from a vault into an active trading desk.
And trading desks get valued differently.
Significantly lower valuation multipliers. An investor would be better off just buying a spot Bitcoin ETF at that point.
It all feels like an incredibly delicate balancing act across the entire corporate sector today. And these massive bets, Coinbase's AI restructuring, Iron's infrastructure pivot, Intel's node advancements, Strategy's share dilution, they are all taking place on a macroeconomic foundation that is suddenly showing deep cracks.
Yeah, the macro data today was sobering.
We received the U.S. job openings report, and it fell slightly to 6.87 million in March. That hovers near a post-pandemic low and represents the lowest level we have seen so far in 2026.
Businesses are actively finding new reasons not to hire. The labor market is cooling down significantly, and the data points to a broader hesitation in the corporate suite.
Let me connect this directly back to the top of our broadcast. We opened by discussing Coinbase laying off 700 people to rely on AI-native pods. Are we seeing the actual, tangible macroeconomic footprint of the AI revolution right here in this depressed 6.87 million job openings number?
I think we absolutely are. It is a vital synthesis of these two seemingly separate news feeds.
How so?
The labor market is currently caught in a dual force contraction. The first force is cyclical. You have general economic uncertainty. Capital remains expensive, inflation fears still linger in executive boardrooms, and leadership naturally freezes headcount to protect profit margins during ambiguous times.
Normal recessionary behavior. And the second force is what we saw with Brian Armstrong today.
Yes. The structural force is the AI-driven efficiency mandate. When a major tech CEO proves they can transition to a maximum of 5 management layers and utilize one-person teams, those job openings don't just get temporarily paused.
They disappear.
They are permanently deleted from the system. Businesses aren't simply waiting for interest rates to drop so they can resume hiring. They are actively re-engineering their entire corporate architecture to function permanently with fewer humans.
Wow.
The 6.87 million job openings number is the physical collision of a cautious economy and a ruthless technological leap.
Which leaves us with a truly provocative thought to mull over as we wrap up this segment.
Let's hear it.
If one-person teams, powered by AI agents, become the new standard across the NASDAQ Q and the S&P 500, if companies can scale their products infinitely without adding headcount, we might need to entirely redefine what a healthy economy actually looks like.
That's a great point.
Think about that traditional corporate blueprint we discussed. In the near future, Will the ultimate metric of a company's agility, its success, and its Wall Street valuation be determined by how few human employees it actually requires to operate?
It's a paradigm shift, for sure. It challenges every macroeconomic model we currently use to measure national prosperity.
And we will be right here tracking every single data point as that shift happens. Thank you for stepping into the study room with us for our highlights of the day.
Always a pleasure.
As always, NovaStream continues 24/7. Stay with us as we transition back to the live feeds for real-time price tracking, the latest movements on global forex pairs, and our auto-curated breaking headlines delivered the second they hit the wires. For now, we are stepping away, but the stream never sleeps. Have a great day, everyone.